Hey everybody, welcome back to Sidebar Social. I'm Dana Stewart.
And I'm Jennifer Grinke. So Dana, I have a question for you.
Okay, I have an answer.
What would you say is one of the biggest issues that we see couples fight about when they're getting a divorce?
That's easy. It's the
Why
house.
Is it so easy?
It's the house. Always the house.
Not the dog?
No, not everyone loves dogs like you. It's the house. Just speaking facts, Jen.
Yeah.
But yeah, absolutely. I would say the house is a huge bone of contention when it comes to divorce. Obviously, children, that goes without saying, but when we come to like property, I would say it's the house. What about you?
Yeah, I'd have to agree. It's the house. I think there's a lot of fear that surrounds the house, just the unknown, like where am I going to live? If the wife stayed home, can she afford the house? Is the spouse going to make the other spouse refinance? There's just so many questions that come up regarding the house, and I'd say definitely fear surrounding that.
Yeah, the fear drives a lot of the issues that we end up having to deal with in the divorce process. But yeah, that's where we have to get creative on how are we going to handle what we do with the residents, And so today we've got a friend of ours coming in to help talk about being creative. His name is Noel Cookman from the Mortgage Institute.
Noel.
Hey, Noel.
Hey, guys.
Noel, you are a specialist when it comes to divorce financing, correct?
I kind of fell into that, but yes.
Yeah, so tell us just briefly a little bit about your background so the audience knows a little bit about you.
Oh, well, I hope I don't reduce the size of your audience when I talk about my background, but I spent 25 years in professional church work. I was a pastor, as people like to call us, but that's where I kind of learned to relate to all kinds of people. I worked with young people, old people, people overseas, whatever. But anyway, it kind of set me up for my next career, which began about 6 years ago. And that is, I thought it was mortgages, but a couple months into that, I realized that I was going to shoot myself in the head if all I did was chase around realtors and try to get deals, because mortgages, the word M-O-R-T means death, so it's not
I never thought about that.
They make TV shows and movies about you guys, not about us guys. So I just kind of fell into this specialty. It was kind of like a what if moment. It literally fell out of the sky. Not literally fell out of the sky, but the idea just came to me when I saw some folks that had gotten a divorce and their decrees had assigned certain debts, and those debts weren't paid, and now they didn't qualify for a mortgage. And so I just began asking, what if?
Mm-hmm.
Yeah, and I think that's a big issue that we run into is so many people have the idea of, I'll get through my divorce and I'll try to get a house later. Mm-hmm. And we've seen, just like what you're talking about in a divorce decree, there could be language that assign debts to people or obligations that the parties have to pay. And if those obligations, if the wording's not drafted correctly, it can have long-lasting consequences for their ability to get funding, right? Would you agree with that?
Absolutely. Matter of fact, that's the number one mistake divorcing homeowners make, is assuming that they'll get that house refinanced and a buyout paid to the ex, and they say, let me get my divorce final, because they think the law comes first and the legal agreement comes first, and then you go to the bank. Well, the problem is you go to the bank and it is what it is. And the bank said, as a matter of fact, banks are telling people to do that to this day. Mm-hmm. But when I first started 20-some years ago, lenders were always universally saying, well, get your divorce final and then come see us. So the folks are just doing what they're told. And we decided to flip the script on that, and we realized that is the number one mistake that divorcing homeowners make, or if you're trying to buy a home, is that they wait until they've codified or they've cast in stone, those terms of that decree, and then they go out and try to, get financing. And a lot of times what's written in their decrees are sabotage what they need, not on purpose, obviously, but there's just certain ways to structure things so that people qualify to get their mortgages. So we kind of flipped the script and said, we'll start early. We'll start before anybody else will. And by the time the divorce is filed, then we'll have their loan really ready to go.
Well, no, I know that I feel very fortunate to have met you early on in my career, and have been able to come to you on so many cases and give you so many clients that you've helped. Oh, we, us?
Yeah,
us.
go ahead.
Okay.
Because I did meet Dana first.
Thank you,
You
for the
did?
record.
Yes.
Wait, this is new
You don't even
information.
remember.
I don't
meeting.
even know.
All
I'll
the
t-
guests that come on this show know me first.
That's
Don't
weird.
forget that.
And like me better.
Okay, shots fired.
Now, we were out in the parking lot of the firm where both of you were working.
Yeah.
And from my perspective, I was talking to Dana, and up comes these two teenage girls. One of them was your daughter.
Yeah.
Barely a teenager, I think,
Yeah,
if I
that's
got my
right.
math
Yeah,
right.
that's right.
And then this other teenage girl turned out to be Jennifer. Like, well, she's actually not a teenager. She's an attorney. Like, okay, well, from my age, everybody looks like a teenager. But
Yeah.
that's how I first met you. And that's nice of you to say that. I appreciate that.
Yeah, thanks. Well, and thanks for all the help you've given to different clients that we've sent you.
Truthfully, you guys do it right. When I say do it right, what I mean is it seems like everybody else, there's the majority of lawyers, mortgage companies, everybody says what y'all have referred to before, get your divorce final, and then they go out and try to get financing. You guys have had the foresight to get folks connected early, and now by the time the divorce is final, they're ready to close their deal, do a refinance with a buyout, or even purchase a home. Is that what you were talking about, where we've been able to help folks in that way?
Yeah, definitely. I mean, I think so many times clients will come to us and they have an enormous amount of debt and they think, hey, I'm not going to be able to qualify. And then I've sent them to you and you've given them a roadmap to get to where they need to get. But not only that, you've come up with creative solutions on how they can not only refinance, but they can pay off all the debt that they have.
Well, if this were not such a huge podcast with millions of viewers, I would tell you the secret. You just opened the door to the secret. But they say go ahead and tell your secrets. Nobody, or less than 1%, will do them. But yes, there's actually a way. I've been told by many people you can't do that, and I love that when they say you can't do it. We just do it, and I'm still not in prison. So for what that's
cheers
worth,
to that.
It's going well.
that ought to impress all the lawyers. But yes, there's ways to structure a buyout in a divorce. It is, as a matter of fact, it's so powerful that sometimes family law attorneys and I will joke about it that, well, I'll get a divorce, get my financing done, and then we'll remarry afterwards. It's that powerful. And if you're divorcing, you're going through a divorce, first of all, you need to call these guys, make sure you don't go it alone or try to do it by yourself. The right attorney is so important, and that's what I love about you guys. You're the model, but so much more could be said about that. But the way that buyout and after a divorce is structured makes all the difference in the world. I would say easily 1/2 of our customers or the folks that call us, they would not get their loan if it was not structured in a particular way. And it really needs to be done before the divorce is final. Every once in a while, we can help folks afterwards if both of those divorced folks are cooperative and amicable and good. Yeah, good luck with that. How often do you see that? I mean, it's nice when you do, but the fact is, you get that structured in the settlement. And you guys correct me if I'm wrong, but I'm not a lawyer. I don't play lawyer. I don't try to create a legal, document that people sign. That's you guys. And I'll tell the customers that call me, your clients, that's between you and your lawyer. The substance of the agreement is what I'm trying to say. That, you know what it has to be, what the parameters of the law are, and you're trying to get to an agreement. But there are certain ways to structure that in the same, you get the same result, even a better result, but the way it's structured and built in that settlement is so crucial. So getting in contact with the folks early on is critical to that. And I appreciate the way you guys see that. And you don't just see a client coming through the door as a customer, we're going to get them divorced, and that's it.
Yeah.
The thing that makes us enjoy our work, and you guys might be wondering, how does a divorce lawyer enjoy their work? Well, do it the way you guys do, and you at least sleep good at night. I love going to, reading a story about a mom with 3 kids that we helped save the house. so that the kids didn't have to change schools, move out of the neighborhood, sleep in the same bedroom. I get these stories quite frequently, and the kids never know. They may never know to come back and thank you guys. Hey, you got my mom or my dad or my parents through this difficult time, and my life was much more stable than it would have been otherwise. But we know what happens, and we can see it, and that is satisfaction enough for us. So
Yeah.
I think I said before, if all I did was mortgages, paper and files and credit and money, and that, I would live under a bridge in a cardboard box before I would just keep doing that and chasing down mortgage deals. But to be able to help somebody, and that's why I like your eyes, how you see people.
Yeah, I mean, that's a big part of our practice is the empathy part and trying to understand what's important to the clients and then putting up a roadmap to get them there.
Follow us and join the conversation on Instagram and YouTube at Sidebar Social.
So, Noel, I appreciate the nice words you've said about us and the way that we practice and trying to help the clients. But I think a lot of that, too, has come from you educating us on what is possible with refinancing and with mortgages, because just candidly, I didn't know all this stuff until I met you, before Jennifer met you. And, you helped us basically understand what we can do. And so I'd like to talk a little bit about just some examples. Like we've had clients before who had a lot of debt. The parties had a lot of debt. Didn't look like, from my perspective, that you're going to be able to qualify for lending. And then you've helped structure deals where if even a party that maybe didn't have a job, then if they get some temporary support coming in and then certain debts are awarded to the other spouse, you were able to make that person eligible to qualify. So can you talk a little bit about that and like the magic that you work behind the scene?
Let me give you an illustration about one thing you just referred to, and then let me get back to that debt that needs to be paid off. One has to do with, you can use child support and even spousal maintenance or alimony, depending on what state you live in. You can use that as qualifying income, but it has to follow a couple of strict guidelines. Here's an example of something I see frequently. One lawyer will say, well, we'll give her $2,500 a month for 2 years, and any bank ought to be happy with that. That's almost verbatim what I heard one time. Yeah, we'll give her $2,500 a month, and any bank would be happy to see that. It's actually not true. That would count as $0 qualifying income. One of the metrics is that it has to continue for 3 years in mortgages. And mortgage folks out there, they'll say, oh, yeah, the income has to project out for 3 years. Well, in a job, you don't know. No employees are going to say, I guarantee income for 3 years, but they just predict, certain things. Well, guess what? In a divorce, it tells you exactly how long support's going to continue, to the month and the year. So we'll say something like, okay, take $2,500 a month, multiply it times 24 months, the 2 years, and divide it by 36 months. And for all you non-mathematicians out there, that's 3 years. That's simplistic, but that's the way it works.
I was about to get my calculator.
And it is like, what does that come to? Do your calculation, $1,670 a month, whatever. And so I asked the customer, listen, will you be okay with $1,670 a month for 3 years instead of $2,400 for 2, or whatever that math comes out to be? And they'll say, almost always, they'll say, yeah, matter of fact, that's even better.
What if they do like a lump sum instead of monthly? Would that qualify, or does it have to be monthly?
Sort of, yes, that can be done in certain situations, but there's a few hoops to jump through. It's a new thing that we've just come on to in the last 12, 14 months. But generally speaking, lenders want to see a flow of income, and it gets all translated down to monthly. That's how you qualify, that famous debt to income ratio. So this customer, when I said, well, give her $1,670 a month, but make it for 3 years. And like I said, there's a few other little nuances there that can be tidied up. But that's an example of, you take money and you're literally creating qualifying income out of thin air. It goes from $0 to $1,600, $1,700 a month.
Yeah.
Now you're cooking with fire. So that's an example of some things that we've been able to do.
And that's money coming in. What about the opposite with a debt? So there's joint credit card debt. And maybe the person who wants to get the financing, if that debt's awarded to the spouse, we've had this situation before, if it's awarded to the other spouse, then how does that play into your calculation with qualifying with the income to debt ratio?
Well, on both sides of that transaction, let's say you're awarded debt and or you simply have debt and it's not awarded to the other spouse, so you're going to be awarded your own debt. You guys write that stuff up all the time. And let's say their debt ratio is too high. We've taken qualifying income, whether it's support income, spousal maintenance, and employment income or whatever, and the debt ratio is still too high. This is something that we see early on because you pull a credit report and you see the debt. And we say, remember, we pre-underwrite. We underwrite to the future, which is how we flip the script. And we say, what debts are going to be assigned to you? Which ones are going to be assigned to your spouse? Generally, they know kind of, sort of. In other words, we begin to build. It's kind of malleable at that time, but you begin to build toward the future. And we say, well, the debts are too much. Then we look at other things like, how much equity is there in the home? What can be accessed? And now here's the secret sauce. Don't share this with your mortgage friends. Well, actually share it with the world. But you structure the buyout so that it accommodates everything you need, a net amount to the X, but then you roll in enough so that the X says, I want you to send $10,000 over here to MasterCard and $10,000 to Visa or whatever.
Right.
And so what you've done is, through a buyout, you've created not the elimination of debts, but you've re-amortized them. And now the first time I tried this, it was a $25,000 CitiCard MasterCard bill, $650 a month. At the time, the interest rates, you could borrow $25,000 for $125 a month. So she's paying $650 a month. And now I say, we're going to try this. And we tried we call it a dispersed buyout. We tried that whole deal. And that took that $25,000 goes from $650 a month to $125 a month.
Got it.
She loved me long time.
I'm sure.
To this day. That was 20 years ago this year.
Yeah.
We stay in touch every year. We just love each other. I've followed her 9-year-old daughter through high school and college, helped her get a job out in California. So, and the husband, I did helped him buy several properties. But it's stuff like that works and helps people move on. They're happy. The finances were better. When you improve your budget, freshly out of a divorce by $525 a month,
that's a big deal.
I mean, that's a big deal for folks.
Well, and that's where it's like we try to always get in touch with you early, like you've been saying, because you can help us look at that big picture, figure out what we need to do. It's like what you said with the decree. We're just shifting around how we may have structured something without your input so that we can qualify. And then I like how we'll send you our proposed language and you can get it to the underwriters and figure out, hey, is this going to fly or not? So again, I think that goes back to what you're saying, do this early versus waiting till after you're divorced.
Oh, that's the key.
Noel, I know we've sent you a lot of people who stay-at-home parents. Do you feel like the work you're doing with them and just, different clients that you work with, are you able to kind of give them a better understanding of their own finances and put them in a better financial position after the divorce?
I just started laughing when you're asking that not because of your question, but because I remember a conversation that I have almost weekly or daily, and I have to apologize because I love doing that. I love helping those your clients get a little more literate about their borrowing, their credit, their finances. And I apologize halfway through a 30-minute conversation. I'm getting into detail. You probably don't like it. And almost universally, they go like, no, I need this information. I'm glad you're doing this. Don't stop. Because if whether it's the wife or the husband, and they're not used to handling all this stuff, they're kind of desperate. And I don't want to say, well, just trust me, I'm going to handle everything. I'd like them to be aware of what's going on. So absolutely. And also, I think that people in general are getting more financially literate or credit and mortgage borrowing literate. I think, 25 years ago when I got in this industry, a lot of things people didn't know. And we've tried to help them understand certain things. So I think folks know about interest rates and points and, premium and things like that more than they did before. But when you're going through a divorce and you're trying to you're doing two things with the financing. You're trying to make your monthly budget work. And if we can do some things like we talked about, that really helps. And they're trying to make sure that they can keep the house in a lot of situations, refinance it and get the X off the mortgage and do the buyout and so forth. They're just trying to solve that house issue, and that all comes down to mortgages and taxes and insurance and the whole thing.
To learn more about Grinke Stewart Family Law, visit GrinkeStewartLaw.com.
So you mentioned, you feel like people are becoming more educated with that, but there's something that most people have no idea about, the OLT lien. This weird word.
Your favorite word.
Yeah, that's your favorite word. I feel like your license plate should say OLT.
Yeah, I did.
But that's an idea.
Yeah, but can you talk a little bit about what the heck that means? I mean, we have to explain this to clients all the time, but you're the expert here. I feel like, why don't we hear it from your words?
Well, I love the OWLT, O-W-E-L-T-Y, because it's a mechanical instrument that helps us get certain things done. It's more widely known now. When I first started talking about it, people thought I was speaking in tongues. I mean, it's like, where they to this day, like, what does that mean? We think it comes from an old Scottish word, and but it's an instrument and it's universal. It's not even just U.S. Even though a lot of states haven't codified it. In Texas, it's in the Constitution, but it's actually a universal concept, and it's without getting too technical, it's called a co-parsoner's interest in a property. It's basically this. If your divorce decree has been written properly, we've worked on it, then you're creating a payment to the exiting spouse, and it becomes a lien on property. And a lot of people say, I don't want a lien on property. That's actually how you get good financing. And when you do it that way, you're able to access more of your home's value. You're not limited to like an 80% loan to value ratio, which cash out financing limits you to. So when I discovered that, I don't know if I'm even pronouncing it right, but I started saying it OLT, and some people say OWLT, and I like whatever. But it's a concept that basically means this: you get a buyout in a divorce-related situation where you're refinancing the house, and that's codified through what they call an OLT lien. You guys know how to do that. You know how to specify.
Yeah, so just to make sure the audience understands, you have one spouse wants to keep the house. They're going to buy out the other one, but they're both on the mortgage. And so then the house or the spouse that's leaving the house, not going to keep it post-divorce, they're the one who will have the OLT lien on the property to ensure that they receive whatever portion of money they're supposed to get as their portion of the equity in the house, right?
You need to come along with me and explain that. That was good right there.
Hey, that's what I'm here for, Noel.
That's the practical way of seeing that. Yes, they have a lien payable to them, the exiting spouse.
Right.
And it's by agreement. Technically, it's by a court order. But if you agree to it, then the court orders it, and you have that. It's called that spouse's interest in the property. And the magic of it being a lien, see, lien has become a bad word. Like, when you pay your house off, you don't have a lien against it. Well, that's nice. But a lien, this is critical. A proper lien is how you get the best financing in a mortgage, because you're paying off in what's called a valid lien on property. And in Texas, it's specified in the Constitution what are valid liens on a homestead property, at least. But yes, the famous OLT lien, one day we'll figure out where it came from, where the word came from.
And so with that, though, you're saying that if you go the route of an OLT, then it allows the homeowner to access more of the equity in the house, so they have more funds available to buy out their other spouse, or not their other spouse, but to buy out the other spouse, correct?
Correct. And because what people say they want, we know what they're asking for. You don't want what they don't really want what they say they want. They'll call and say, I've got to refinance the house, get cash out so I can pay my ex. Cash out is actually a legal term in Texas, and it's an industry term all across the country, but it means you're cashing out. It's a type of a loan. and it's a higher interest rate, and it's limited in how much you can borrow against it. You can't touch the top 20% of the value
Right.
of that home. So that's when you're cashing out. So we know what they're saying. And we say, well, the good news is the loan you're going to get is not a cash out loan. And we have walked them through all that, but it's because of that lien payable to the the ex-spouse at the time, the exiting spouse, that enables the borrower to get the best kind of financing. They're paying off a regular lien.
To connect with today's guest, Noel Cookman, you can follow him on Instagram at Noel Cookman. And to learn more about the Mortgage Institute, you can check out his website, themortgageinstitute.com.
Noel, what would be the fee if we were to get a client over to you, at the beginning of their divorce to just start talking through some of this with you? What would be your fee for that?
Well, for 25 years now, I've tried to not charge fees because I think I found something that really works for everybody, the lawyers, the clients, the homeowners, my customers, me, and that is we don't have any fee. I make my livelihood.
That always works.
Free is good.
Well, I do get paid, but think about it. I'm a loan officer. I get paid by doing loans. And you're basically paid on volume, how much you're able to close, and there's a set percentage that you get, more or less. And so what I've done is give my expertise and the creation of this loan on my end of the transaction so that I can just get it done. And I look at it as if I don't do that, then nobody has a deal. I don't get a deal. I don't close a deal. So I really don't charge fees. The only time I charge a fee is when somebody just kind of calls out of the blue and like, I want to go over my options and can we talk to you and so forth. And we've started introducing some limited fees there just to go over options with people. But even then, I credit them back that amount and some if they close their loan with us. So it's almost like I'm paying them to give them
Well, I know that's
consultation.
and that's been good with our clients because we've sent people to you and we let them know, hey, look, you don't pay anything up front. You go meet with Noel, meet with his team, provide the information, let him work his roadmap, and then we can see what's possible and then work with you to help figure out the language that we need for the agreement. So I think it's been really beneficial for the clients we've had.
I love the way it works because divorce is expensive enough in many different ways, but to add another fee, I found a way not to do that.
Do you know why divorce is expensive?
Here's what I tell people is that if you'll agree on everything, that's the cheapest way to get divorce.
Is this a
To get
joke?
divorced.
It was, yeah. Yeah, because it's worth it.
It's like the guy, he's in the graveyard, bent over a tombstone. Why'd you have to die on me? Why'd you have to die on me? Why'd you? And the guy walks up and says, "I'm so sorry about your spouse, your wife." He said, "It's not my wife; it's her first husband."
That's a new one.
Yeah, that's a good one there. Well, any, I guess before we wrap up, Noel, any kind of final thoughts you have that you want to share with our audience?
We talked about one of the biggest mistakes people can make is just waiting too late, and that is a mistake. But I think another big one is people will tend to qualify themselves, say, "Oh, I'm not going to have a problem getting a loan." And they'll disqualify themselves, or they're sitting around a table talking about it. Maybe the other lawyer says, "There's no way she can get financing." And I just beg the folks, look, don't qualify or disqualify yourself. Because a lot of times there's a way when people don't think there's a way. A lot of times there are roadblocks when people don't understand the roadblocks. And if you would just not make that mistake too, don't qualify yourself, don't disqualify yourself or the client or the other side, then, and of course I need to look at the deal and figure out a way to do it. But let the people who lend the money make that kind of a decision. And you won't be, living life from one bad assumption to another. So don't qualify or disqualify yourself.
That's good advice.
It is good advice. You should put that on a T-shirt.
And I never did use my phrase, "We turn white paper into green money." That's my motto. We turn white paper into green money.
I like it.
Whatever.
Well, Noel, we appreciate you coming on, and again, thanks for everything you've done for our clients and everything you will do for the future clients.
Thank you,
Yeah,
guys.
thanks, Noel.
Yeah, we
Thank you.
appreciate you. And all right, everybody, we will see you later on Sidebar Social.
And my wife loves y'all so much. She was thinking about getting a divorce just so you could be her lawyer.
We'll just hang out
She
with
promised
you.
to remarry me afterwards.
Yeah.
But you've heard that scandal before.
Yeah.